Let me give you a number that should completely change how you think about your capital raising strategy. $5.5 trillion. That's the total wealth currently managed by family offices globally as of 2026. And here's a projection that should really get your attention. That number is expected to reach $9.5 trillion in just a few years by 2030. That capital is patient. It's flexible. It does not have a 20-person investment committee slowing down every decision. And right now in 2026, it is actively looking for exceptional fund managers to back. So here's the question you need to sit with right now. Is that capital flowing into your fund, or is it flowing into someone else's? Because here's the truth. Most fund managers are leaving family office capital on the table. And it's not because their fund's not good enough, but because they do not understand how family offices think, how they make decisions, and what it actually takes to earn their trust and their check. So today I'm going to fix that. This is your complete playbook for accessing, engaging, and closing family offices as LPs in 2026. Let's get into it. And a quick note before we dive in, everything I share today is just for educational purposes only. It's not investment, legal, or financial advice. So you want to make sure you always consult with your own qualified professionals before making any decisions. Now, with that said, let's build your family office playbook together. So first, let us understand exactly what we're dealing with. Because if you approach a family office the same way you approach, say, a pension fund, an endowment, you're going to lose every time. See, family offices are not passive check writers. They're active partners who expect a high degree of professionalism and strategic insight from the GPs that they back. Their primary goal is to preserve and grow wealth across generations, not just quarters. Decades, not quarters. That single insight changes everything about how you approach them. And here's something that matters enormously right now. Global family office portfolios currently average 38.4% in public equities and 38% in private investments. That private allocation is where you and I live. That is your opportunity. But here's the catch, and this is critical. Fundraising concentration has reached the highest level in over a decade. Capital is consolidating with top performers. First-time and smaller fund managers face the most challenging environment since 2007, with LPs consolidating relationships and rewarding a narrow pool of proven managers who can demonstrate realized exits. So, what do we do? Well, the window is wide open, but the competition for attention, it is fierce right now. That means how you approach family offices matters more now than ever before. So here's the basic move. 4 steps. Execute these before you reach out to a single family office. So the basic step is you want to build your target list using the right databases. You cannot hit a target you can't see. So the first thing you need to do is get a verified current list of family offices that are actually aligned with what you do. And here are the specific platforms that I recommend and how to use each one. The first platform that I recommend is FINTRX. FINTRX has a comprehensive database on over 4,400 family offices, including investment preferences, direct investment activity, and key decision makers. What makes FINTRX particularly powerful is its relationship path feature. It eliminates cold outreach by uncovering high affinity contacts. So those are people who are your teammates and you're already connected to. So what they do is they'll scan for shared education, prior work history, board involvement, personal affiliations, and even team networks that surface the best path and serve it up. So this is how you turn a cold list into warm introductions. You can start there. The second platform that you can look into is AdvizorPro, AdvizorPro, and then PRO. So AdvizorPro is built to function like a live intelligence engine, not a static database. So it continuously refreshes, enriches, and activates family office records inside the workflows your team already uses. So you can view total estimated assets under management, allocation style, whether it's equities, alternative, private credit, real estate, whatever they're into, and see who they invest with, what sectors they focus on, and how active they are across fund vintages and geographies. So it really just pushes profiles directly into, say, whatever you use, Salesforce, HubSpot, Microsoft Dynamics, whatever it is. Or maybe you just do manual imports if your team's running a CRM-based process. So AdvizorPro can be a really, really good engine. The third platform is family office databases. This is one of the longest running, most credible databases of family offices, with over 24,000 listings across multi-family offices, single family offices, wealth management firms, fund of funds, endowments, and pension funds. So they got it all. So pricing starts around $1,000 for 30-day access. And so for a fund manager who's seriously targeting family office capital, that's just a rounding error. And then the last one that I recommend is a CRM that I've put together. So it is a Fund Raise Capital CRM. You can message me and we can get into details, but it's crm.fundraisecapital.co. And you can get in there with over 160,000 investors. It's a CRM that is built with capital raising in mind. And so it is a phenomenal database. So those of you who know me, I don't believe in buying lists, but I do believe in accessing key databases that are attached in really great software. So here's how you use those tools. So you go to any of those platforms and filter by 3 criteria. Asset class focus. So are they active in your asset class? This is probably the biggest irritant to a lot of investors, whether it's family office or otherwise, is saying, hey, we're a venture capital fund and this guy's sending me a deal in real estate. Did you even look at our website? So don't trash your reputation by just spray and pray method of sending your deals out. Make sure that you understand who they are. And that's why I love databases, because it gives you context of what they like. And then what about check size range? Do they deploy at your minimum LP commitment level? That matters. So we have a minimum level in a lot of our fund docs, hopefully all of them. And when we go in there, we have to say, well, do they cut checks at least to our minimum? So having really high minimums in your fund docs, if you're building a fund, that can actually come back and bite you. So really making sure that you work with your lawyers and your financial advisors on what would that sweet spot be. And it sounds nice to say a $5 million minimum as an emerging fund manager, but are there family offices where that's not possible? Yeah, there are. But there's also family offices who cut way bigger checks. So really just think that through and work with your team on that. And then what about geography? Are there markets where your fund is compliant that you can raise? So you export that filtered list into your CRM, and this is the start of your capital raising universe. So before you contact anyone on that list, you got to do your homework. So for each target family office, you want to know 4 things. So number 1, what is their wealth origin? So again, this is totally opposite of the spray and pray. And if you've been following the show, high finance is more about trust than it is transactions. So a great way to build trust is know who you're talking to. It's really impressive that you know the background. So a family that built wealth in technology thinks differently than, say, a family that built their wealth in real estate, and especially when it comes around risk. So the context here is everything. And without it, even the strongest fund can totally miss the mark. Number 2, what is their current portfolio allocation? So if you're looking for gaps, if they're underweight in your asset class, that is your entry point. Number 3 is who's the actual decision maker? Is it the patriarch or matriarch of the family, a hired CIO, a next generation family member stepping into that investment role? Maybe they do it by an investment committee. Each of these requires a completely different conversation. So make sure you understand not only your deal, how they made their money, and the asset classes that they like, but how they make decisions, because that matters. And then number 4 is what's their investment horizon and liquidity preference? A family office focused on multi-generational wealth preservation needs to know you understand their time horizon. So you can use things like LinkedIn databases, the ones above, and Google to pull that information before you ever send any kind of message. So the next thing that you want to look for is getting a warm introduction. Those always help because coming from someone who they trust and that person with their trust sends it to you. This is why it is a really bad move to email a stranger and a fund and then say, and this is like old school sales techniques from the 1950s that say, well, then who do you know that would be able to help me out? And I get those all the time. And I know the game. I know what people are trying to do and they're trying to raise. But what you're really asking is to say, hey, Ryan, I know you've probably spent 2 decades building trust with these people and hundreds of thousands of dollars. And can I get the benefits of 2 decades in that for free? The answer is probably not. So I just want to be really direct with you about that. See, family offices and their representatives count the number of cold pitches they receive every month, not by hundreds, but by the thousands. So cold calling, cold messaging, it's not going to get you anywhere. But warm introductions from people that you've built trust with, that you have a mutual contact, they're not just preferred, they're essentially required. So here's exactly how you build a warm introduction pipeline. Easiest thing to do is just go to LinkedIn and search for the family office that you're targeting. You look at their team page, and now cross-reference that with your own LinkedIn first and second degree connections. Who knew you could do that? So now you can find who you know that knows them, and that's a great start. And then you can go back to a place like I mentioned before, FINTRX relational path feature to do the same thing systematically across your entire target list. So it scans for shared education, prior work history, board involvement, personal affiliations, and teammate networks to surface the best path in using both your personal data and your team's maximum visibility. So once you have that in place, now you identify a connector and reach out to them directly. So you want to keep the ask simple and specific. Something like, I'm targeting family offices in the private equity space, and I notice you have a relationship with the team at X family office. I'd love a brief introduction if you feel it's appropriate. Would you be open to that? Now, since you already know this person, maybe they're your college roommate as an example, but you've already built that relationship. That's key. So doing that, I think now you're able to work with the trust that you've earned with these other people and the trust they've earned with the family office. Now it's a big circle of trust. And like I said, high finance is more about trust and transaction. So when you know how to use that effectively and with integrity, now you're in a good spot. So once you have that in place, you just want to follow up with a 1-paragraph summary of your fund and what you can do moving forward. Just clean, professional, and absolutely no fluff.
Hey, if you're finding value out of this discussion, could you do me a huge favor? Could you just take a second and hit that like or subscribe button? It costs you nothing, but it tells the algorithm that this is valuable information, and it helps us to get it to more people. Thank you. You're incredible. Now let's get back to the show.
So then step 4 that you want to do is make sure that when you go in, and I know nerves happen, that's why we practice, is you want to speak to their portfolio and not your fund. And this starts to become more and more important as you move from, maybe like most people, you come up from pitching retail, but now as you start approaching the institutional side, this matters a lot. See, so now you talk about their portfolio, their risk management, the things that you understand about them and the preferences that they have, instead of just go and monologue about how great your fund is and how smart you are. They'll get to that, obviously. But we want to make sure, and they want to make sure, that they invest in people who truly understand what they're trying to do. Nothing's worse than misalignment of an employee or a business partner who just doesn't understand what you're trying to do, and they're only interested in what they're trying to do. Can you see how this would cause friction in the pitch? So when you get the meeting, and you will get the meeting, do not walk in and deliver a monologue about your strategy and your returns. Spend at least the first 20 minutes just asking them questions. Show that you're genuinely curious. What are they seeking? What gaps exist in their current portfolio? What keeps their chief investment officer up at night? Then, and only then, show them precisely how your fund fills one of those gaps. And make sure it's true and make sure it's honest. Don't play games. This is not a place to do that. So really come from the right opinion that you say, great, you have inflation. We do real estate. This performs well in inflationary environments, whatever it is. I'm just using that as an example. But you really want to make sure that you understand what they need instead of talking about how brilliant you are. So they might believe that you're brilliant, but they also might believe that it's still not a good fit. So make sure that you understand how to tailor your pitch, because every family office is very customized. And so you just want to position your fund as a diversification tool. Position it as a theme play. Maybe you position it as a way to get exposure to something their current portfolio cannot reach on its own. So what that does, and again, if you've been listening to the show for a while, you want to transition yourself in their eyes from a deal jockey to somebody who is a solution architect. And so people and the institutional side and family office side, they want people around them that can solve problems, that have solutions. And so if you're showing up as someone who's just peddling deals and I just need money to do what I want, well, you can imagine that probably won't go well. But if you're in a position where now you say, hey, what are your problems? I just want to understand what it is that you guys are looking for. What do you love? What's working? What's not working? And then build a solution for them. And if that means your portfolio happens to be part of that solution, then go for it. But either way, I'm not saying give financial advice, but I'm just saying understand what they're lacking and see if your product or your offering can help fulfill something that they're lacking, or maybe help their CIO to sleep better at night. So in this regard, that is the basic move. Target, qualify, warm introduction, portfolio fit conversation, 4 steps. Execute them before you ever pick up the phone. Now, with the basic move covered, let's talk about something more in the pro move space. So here's where the top fund managers separate themselves from everyone else, or as I like to say, where we separate the fund titans from the fund tourists. It's what pros do that managers never figure out until it's too late. So pro move number 1 is get your first family office LP, then let them open every other door for you. See, the thing about family offices, and I love this, as I was starting to learn raising capital principles, I realized that family offices, they're kind of pack animals. And I mean that in a good way. And they have very powerful networks. They actually network with a lot of family offices. Now, is that 100%? Probably not. But a lot, especially from my experiences, we've seen a lot of people who get in with the right family office, they also have other connections as well. So this is one of the most powerful and underutilized strategies in capital raising, I think. So what you do is, on a pro move, is you want to find one family office as, we'll say, your sponsor. And once you have found one family office that backs you in some shape or form, you have received the validation needed to make it easier to get in touch with the other ones. So we talked about that warm referral in other ways. And so this is another one of those techniques, but done at family office, referring you to another family office. So family offices, like I said, they know other family offices. And once one backs you, they will be able to give you introductions. And they will have it in their self-interest to do so. Because once they are invested with you, they want to see you succeed. That's why they invested with you. So think about what this means strategically. Your first family office LP isn't just capital. It is literally the key that can unlock every other door in that network. So you want to treat that first relationship like the most important relationship of your life, maybe the second most if you're a happily married man like I am. But you want to treat that as one of the most important relationships in your fund. Why? Because it is. See, a real world example of this principle in action is when Ray Dalio, he started Bridgewater Associates out of his apartment in 1975. So he didn't try to raise from everyone at once. He just focused on building deep credibility with a small number of early clients, including McDonald's pension fund, and let that validation compound into the institutional relationships that eventually made Bridgewater one of the world's largest hedge funds ever. So one credible backer at a time. That's what we're saying. So pro move number 2, offer a co-investment access as your door opener. So this is one of the most powerful tools you have, and most emerging managers never use it. See, family offices seek more than just compelling investment opportunities. They value strategic partnerships that align with their long-term vision. In fact, I would argue that this is something that from family offices and bigger, so pensions, endowments, mega funds, they all want that. And so offering customized investment structures or co-investment opportunities where applicable significantly improves your chances of raising capital. So here's how to use this tactically. So when you're building a relationship with a family office that has not yet committed to your fund, invite them into a co-investment on a live deal. No management fee, no carry, just pure deal flow access. And why does that work? Well, I think it works because it lets them see your sourcing capability, your deal judgment, and your execution in real time. No fund commitment required. They are evaluating you on a live deal. And if that deal performs, the conversation about a fund commitment becomes infinitely easier. See, according to PricewaterhouseCoopers 2025 data, 83% of family office startup deals are now structured either as co-investments or club deals. See, co-invest is not a niche preference. It is how the majority of families, they choose to allocate into private markets today. So you want to build a pipeline of co-investment opportunities, specifically for your top tier family office prospects. And you want to make them feel like deal insiders before they ever formally invest capital as an LP into your fund. That's how you close. Now, pro move number 3. You want to build a communication cadence that makes them feel like partners, not just investors. Successful managers understand that family offices operate on relationship timelines spanning years, making ongoing engagement critical for long-term success. So quarterly communication through investor letters, calls, and other annual meetings, they represent the gold standard. But here's what separates the best from the rest. It's not just about sending quarterly reports. It's about adding value between each capital raise. So here's a specific communication framework that you could implement today. Every quarter, send 2 to 3 page investor letter, not just returns and portfolio updates, but give them your read on the market. Share what you're seeing in deal flow. Tell them what you passed on and why. Make them feel like they have a window into your thinking that nobody else has. So access. Lots of people love access. You can provide it into your thinking. And even every 6 months, you can offer a co-invest opportunity or a first look into an emerging deal. Even if they pass, the gesture does build trust. So it goes back to trust before the transaction, or as I like to call it, my Fund Raise Capital formula. So once a year, you do a personal phone call or an in-person meeting, not a group webinar, a one-on-one conversation asking them about their portfolio priorities for the coming year and what they're seeing in the market. So I like to do this September, October. That tends to be a great time to start doing that because that's budget season. So we want to get in front of them right before budget season is what I like to do, and really just understand what are their priorities, what do they care about. And then in between all of those meetings, send them one useful thing a month. An article you found insightful, a framework that you developed, a connection you think would benefit them. Make deposits into that relationship account consistently so that when you do call to raise your next fund, you're withdrawing from a full account, not an empty one. So this is how we warm up those leads and build the trust. So now let's talk about some of the action steps. So here are your 3 action steps. Do all 3 this week. Step number 1 is you want to set up your database access and build your target list. So this week, go to FINTRX, AdvizorPro, Family Office, or the Fund Raise Capital CRM and leverage those databases and sign up for your trial subscription. Some of them have them, some of them don't. But you want to filter by your asset class, your minimum check size, and your target geography. You want to export that list into your CRM, whether that's Salesforce, HubSpot, Pipedrive, or even some finance one like the one we do. And then place that in a clean Excel spreadsheet. So you should have a qualified list of at least 50 family offices by the end of this week. That is a starting pipeline. Action step number 2, you want to map your warm introduction network. So this is where you open LinkedIn, go search the names for the top 10 family offices in your new list. Then cross-reference their team pages with your first and second degree connections. So for every connection that you find, you want to send a short, specific message on that week asking if they would be open to making an introduction to whatever family office that you have targeted. So if you have, for example, if you have FINTRX, you run that relationship path on your entire list, let the tool do the heavy lifting. So your goal is to identify at least 5 warm introduction opportunities by the end of the week or Friday. And then action step number 3, you want to rewrite your opening pitch. So pull up your current investor deck or fund overview right now, as long as you're not driving, as long as it's safe. But when you have the chance, open that up and look at the first 3 slides. If they're talking about your fund, your strategy, your team, your returns, rewrite it. Your new opening should lead with the gap you fill in their portfolio. Sometimes I like to call it, and this is what we talk about that in I call it the battle council at Fund Raise Capital. Talk about the bluff. It's the bottom line up front. And so you want to lead with the theme that you represent, lead with why a family office that is underweight in your asset class needs exactly what you offer. So test that in your new opening in your next 3 conversations and watch what happens to engagement. Now, one more thing before I let you go. Raising capital from family offices is not something you figure out overnight. And the biggest mistake I see fund managers making right now is trying to do it alone. No sounding board, no one to pressure test their strategy, and definitely no battle counsel. This is exactly why I built Fund Raise Capital. It's a community of serious fund managers where we discuss live deals, sharpen strategy together, and help each other avoid the costly mistakes that solo operators are making every single day. So if you want in, the link is in the show notes. So you are welcome to apply for the Battle Council. Just click the show notes and the link will be there. And finally, I put together a comprehensive visual framework for today's episode. It's called the Family Office LP Playbook for 2026. It breaks down everything that we covered today: the target research process, the database tools, the warm introduction framework, the basic moves, the pro moves, and all 3 action steps into a clean, professional implementation guide that you and your team can review immediately. So you can grab your free copy, just head over to the link in the show notes and you drop your information and it's yours. Zero fluff, just the playbook, free of charge. So once you get those in place and you implement those, raising capital from family offices now becomes a lot clearer. You do these things and you too will enjoy your pursuit of making billions.